Hi there and welcome to Jill's Quest for Riches. Now in today's episode we are going to discuss what exactly is an ETF. Why am I making this video? Well, I think first of all that ETFs are a very easy way to diversify your investing portfolio and maybe even just an easy way to start investing as a beginner. Second to that, and maybe more importantly, is that it is a very good tool for one of the best possible investing strategies that is out there, which is index investing. Why is that so, and what is index investing? That I'll explain later on in this video. Let's get started. Before we go any further, I just want to point out that I am not a professional financial advisor. These videos are purely based on my personal experience and knowledge in this field. Now let's start by defining what the letters ETF stand for. Well, they stand for Exchange Traded Fund. And to make things easy, let's start with the last word here, fund. Because basically an ETF is a type of fund. Now what are funds, you might ask? Well, the easiest way to describe a fund is as an investing instrument that can be compared to a basket. A basket containing a range of stocks, shares, or bonds, or commodities like silver, gold, oil, anything basically, or properties, real estate properties, currencies like the pound sterling, the euro, the dollar, or a mixture of multiple of these assets. The advantage here is that you buy a stake in this basket, and as a result you have exposure to multiple assets and not only one asset as you would when you go and buy silver or when you go and buy one specific stock. That's a big advantage of funds. Now there's a big range of funds. From one side based on which assets are in there, like stocks, bonds, a mixture of stock and bonds, commodities. But you could also start categorizing them based on other things. For example, quite some funds try to replicate or track specific indexes, markets, sectors. A famous, very popular index to track is the S&P 500. Which contains more or less the 500 biggest American companies. But you could also have a fund that is tracking the Dow Jones or the Nasdaq. Next to that, you could have funds that are tracking a specific market, let's say European market, US market, Southeast Asia, or a specific sector or industry like the healthcare sector or the energy sector. And then when we go to the first two letters, exchange traded, well, this simply means that this fund can be traded on an exchange just like any stock or share, which is a crucial difference with many other funds, because a standard fund usually is traded through your bank or through a specific financial advisor or any other intermediary. There's a few other dimensions as well which you could use to categorize different types of funds or ETFs. The first one would be accumulating or reinvesting funds or ETFs compared to distributing funds. What's the difference? Well, to give you an example, a fund might be holding different stocks which themselves give a dividend. Now these dividends are given from the stock, from the company to the fund in which you're invested. And then the difference between an accumulating fund and a distributing fund is that the accumulating fund will use those dividends and reinvest them to go and buy more stocks, whilst a distributing fund would be using that dividend that it receives to distribute to its own shareholders or its own fund holders, let's say. That's an important difference. Why is that? Well, it depends usually on which strategy you want to pursue. If you're in your late teens, early 20s, 30s, you might be more interested in focusing on growth, and then reinvesting makes more sense because whatever you would do with the money that comes out is reinvested anyway. Whilst when you are maybe thinking about retirement, then you might be more interested in distributing funds because you don't want to be bothered with deciding which investments you need to sell every single month just to cover your expenses. You prefer to have investments that pay you out monthly or quarterly so that you don't have to look into it anymore. You should also take into account which regulation or taxes are used in your jurisdiction or your country. To give you a practical example, here in Belgium we are taxed on our dividends, I think 20 or 25%, but we are not taxed on capital gains. So if a stock increases in value and then we sell it, we are not taxed on the difference in value between when we bought it and when we sold it. But we are getting taxed on every revenue that comes from the dividends the stock is paying out. So, all things equal, as a Belgian resident, I would prefer that when a fund receives dividends, they reinvest it so that the value of the assets in their portfolio increases instead of distributing it to me, because then I pay taxes on the money that is distributed. Another dimension that we should discuss is funds that are actively managed versus funds that are passively managed. Well, actively managed funds, it's quite easy. You have a fund manager or a team maybe that every day, every week decides on, okay, should we buy this or that stock? Should we buy more of this or that asset or sell some? Whilst a passively managed fund is based on a set of rules. For example, between this and this percentage of our assets should be in this stock or in this class, and this percentage should be here, and this percentage should be here. And whenever one of those parts grows too much, they sell part of it. Whenever they get new money in, they distribute it according to the distribution that they have decided upon. So that's passively managed. It requires way less time, effort from the fund itself, and that also results in way lower costs usually. The last dimension that I want to discuss with you is whether or not a fund or ETF is holding an actual position in the assets it is tracking. What's the difference? Well, the basket that you're buying into might be tracking the S&P 500. So what you would expect is that the fund that you're buying has shares in each of these 500 companies, right? That would be the normal way to do things. That would be holding actual positions. But what you could also have is a fund that doesn't hold actual positions in these 500 companies, but actually holds multiple financial instruments that mimic the price performance of these 500 companies. Why would you do that? Well, that way you could probably, with less money, more easily mimic the complete list of the S&P 500. It could also result in less transaction costs because you don't have to rebuy and resell each and every individual share of these 500 shares. No, you might have an instrument that is tracking part of it, or two instruments that together balance out a big part as well. So you would have less transactions as well, which could result in cost reduction. Personally, I don't know too much about these derivatives, so I always prefer to have funds that have actual positions, but this is really a personal preference, so don't take this as financial advice. So now we've come down to what the advantages are of investing in ETFs. Now, compared to regular funds, it's way easier to trade ETFs. You can trade them on the stock exchange just like regular shares. You buy them, you sell them anytime between the opening and the closing of the stock exchange. You always have a price à la minute, let's say, on the spot. And you don't have any intermediaries that also, one, take some time, but two, charge an extra fee. The next advantage is diversification. Now, ETFs and funds play there the same advantage. They diversify compared to regular stocks. That is, you could invest in a whole industry, a whole market with the same amount of money that you would use to just buy one share in one company, which spreads the risk, of course. The next advantage is more focused on the transparency of the costs. When you buy an ETF, the only cost you should be looking at is the expense ratio, and that is the percentage of the total money that the fund is managing, which it charges as its fee. And this can range from, let's say, 0.1% all the way to 0.8%, let's say. Although I preferably go for ETFs that only have an expense ratio of less than 0.5%. And the lowest I've ever heard about is a expense ratio of 0.04 or 5%, which is really, really low. The big advantage here, that's the only thing you should look at. Whilst when you invest in funds, you have, apart from this expense ratio, maybe also setup fees, entry fees, exit fees, maybe some premium fees when there's a high return in specific years. So there can be all these extra costs involved as well. Not the case with ETFs, very easy, very transparent. Linked to this advantage is another advantage, and that is that usually the costs with investing in ETFs are lower. Why is that? Well, first of all, there's no intermediary. You can exchange directly on the stock exchange. Secondly, especially when you go for passive invested funds, you also have way less overhead. The fact that it is traded on a stock exchange also makes that it is way more accessible, so it's more easily to accumulate more money under management, more assets under management, which spreads the overhead costs over a bigger amount of money, which in return makes the share of the overhead costs that you are paying lower. Now, that doesn't mean that any ETF is less expensive than any fund. It's just in general, ETFs are less expensive than funds. What's also nice is that you really have a lot of choices when it comes to ETFs. There's really so much different options that you have. Usually the minimum investment that is required is also lower compared to, let's say, a fund offered by your bank. There you might need at least 1,000 euros to step in to be able to purchase one part of that fund, whilst when it's an exchange traded fund, it might be as of 8 euros, 10 euros, maybe 5 euros that you could hold a part of that basket which the fund represents. And when you compare it to stock investing, fund investing, and particular ETF investing is a way more passive investment style, which means less time to invest for similar or sometimes better returns. And this last point immediately brings us to what I promised you in the beginning of the video, and that is why are ETFs such a good tool to do index investing, and more importantly, why is this index investing strategy such a good strategy? Well, the first and foremost important fact that you should be aware of is that passively managed index funds outperform actively managed funds. Now, let that sink in for a bit. It means that when you invest in a fund, through a regular fund or an ETF, that passively tracks based on a certain set of rules an index, let's say the S&P 500, then that fund will on the long run outperform nearly all funds that are managed by highly skilled professional fund managers. And at first that might seem strange, but actually there's been multiple academic studies that confirm this. These studies have been executed over large time spaces, sometimes even 100 years. And on top of that, even the best professional investors like Warren Buffett actually actively advise this type of investing, being index fund investing. So the main conclusion here is that for most people, and also for quite some professional investors actually, it makes more sense to invest in passively managed index funds, because the cost will be lower, you spend less time on it, and your returns will be higher. And that brings us to the start of this video. Why ETFs? Well, they are the most appropriate, cost-efficient, easy instrument to invest in these passively managed index funds. I hope you enjoyed this video. If you learned something, please click that like button. If you want to see more videos like this in the future, be sure to subscribe and maybe have a look at some of the other videos on my channel. Have a nice day. Ciao.